Good morning.
Good morning. And they're rolling in. Yes, they are.
Yep. It did it.
I know. We can do this stuff.
Good morning, everybody. Good morning, Kevin Casey. Good morning, Dave Luna with Mortgage Educators. So good to see your face today. How's everything in your world, Dave?
That's so good. It's great. I don't know. I sound like a broken record. It's always going good. You know.
Look great, by the way.
Do what?
You're looking great.
Considering all the health challenges. Yeah, thank you.
Good. You know.
All right.
Looks like they're rolling in here.
Yes.
It takes a minute or two for them all to roll in, but I think
it's 11:01. I mean,
we have to get
good.
This can't be tardy.
What?
They can't be tardy. All right. So what's the date today? It's 12th of July.
My sister's birthday.
Yeah.
All right. So Dave, as always, there's a few things going on in the mortgage industry. Can you imagine?
There are.
Imagine. So let's just start here because I thought this was really. I was going to go with funny. Maybe I should say interesting. So the headline is ready. Former FHFA head Mark Calabria to join Evolve Mortgage Services Board, and he was described as an elite industry legend and luminary. So that wasn't quite my take on him, and I'm curious. I mean, do you have any thoughts on what does he bring to a board, right? Like, what is he going to do for a company? And is this what happens when you are no longer head of FHFA?
Well, let's not take anything away from Dr. Mark Calabria. I mean, He is a PhD.
Okay.
He is an economist. He does know what he's doing.
Does he?
Or at least, in his mind, he believed that the direction he was taking FHFA was the right direction.
Okay,
we all know
enough.
that FHFA is the regulator over Fannie and Freddie. Whether you like or dislike what he did there, I mean, he got the job. And that's not something that they would ever task me for, though I think I do know a little bit about the mortgage industry. So let's not take anything away from anybody. And so they're looking at this legend, and I like the descriptor when you said that on legend. I don't know what makes a legend. I mean, heck, I've been called that by that same word as well, which I absolutely do not deserve. But let's not take anything away. To get a PhD is I think an accomplishment. So I do think he does bring to wherever organization he's at some things to the table.
Well, that was a very sweet assessment of the situation, Dave Luna. I appreciate that. Leave it to you to put a positive spin. And yes, I know a lot of people with PhDs, and so there you go. I'll just leave it at that. Anyway, so it'll be interesting to see what he does for that board. I'm curious, actually, like, what does he bring to the table as far as, an expertise in the
definitely
board?
An insight to how the CFPB works and runs.
Or FHFA, because
FHFA,
when he was at the helm of FHFA, the CFPB was a slightly different animal than it was prior and after, right?
That's right.
So does he really know how it works? Maybe, but maybe not. So again,
another key part that you said is a board. So the individual, Dr. Calabria, is not working by, himself in a cylinder, in a vacuum. There are other voices. So again, when you have, 2 or 3 or more folks together, like what we have in this panel today, it's going to be harder for any one of us to go off the rails because the other 2 will bring that person back. So let's see what happens.
Well, unless we're all insane, in which case we just go off the rails together. So moving on, I read this little blip and I reached out to our Heckham friend because I saw this notice that FHFA had extended a provision where if people are behind on their property taxes
due to COVID.
Well, okay. So anyway, and it was interesting because they weren't really familiar with this and they checked with their people. And so anyway, bottom line was, if you have borrowers who are upside down on their taxes on it with a HECM, reach out for help because help exists. And I can't remember the date, Dave. Do you remember?
It was the end of June. And so it was only like about 2 weeks ago where FHA put out their circular talking about The key part was COVID, but it would apply, anybody being late. Nobody wants to foreclose on grandma. And so they're saying, okay, the amount of money that you could have received, we're going to use that money. We're going to go ahead and bring your taxes current. Your balance is going to go up, but you get to stay in the home. And it just, again, brings people current so that we don't have foreclosures against, some of our more senior individuals.
Yeah. Well, God, we definitely do not want that, right?
Right.
Okay. So I thought this was interesting this week. So there's a lot of conversation about inventory levels and prices and what's going on in the market, right? So this is from MBS Highway and Barry's group. So they were comparing last year to this year, selling above asking price. Currently, 52% of properties are selling above asking price. A year ago, I feel like I'm hosting a game show all of a sudden. A year ago, any guesses on what that number was? Today, 52% selling above asking. What was it a year ago?
It was going to be much, much higher than that. And in a year from now, it's going to be much, much, much lower than that. We're already starting to see the trend that people are not getting what they're asking for. I was reading earlier that 60,000 people that were already under contract to buy a home just totally backed out. One, interest rates are higher than when they were originally approved. And two, they're just sitting there saying, wait a minute, I have more options. I'm looking at more inventory. Inventory has changed radically in the last 3 months, that there's just more choices, more options, and people, they're going to take advantage of them. Also, in purchase contracts, what they're also doing is they're saying, you know what, let's see what appraisal number comes out. You know what, let's see what the inspections are. So the contingencies are not being waived as much anymore. So you're going to see less and less above asking. In fact, here in California, in the Southern California area, LA, that's already started to happen.
Okay.
So sellers are just saying, that they're asking for the sky and they're coming back down to reality.
Okay. So this is going to be surprising to you, just as it was for me. Currently 52%. A year ago is 53%.
That's kind of what I thought.
Okay. Listen to this. And because the news, it depends on where you are, definitely. And there are, as we were speaking with one of our speakers a couple of weeks ago, he had indicated that there are markets throughout the country that CEOs of companies are really watching. They consider them to be overbought. Surprisingly, none of them were in California. I mean, none, not one. Okay, so listen, I'm going to go through the rest of this because it was shocking to me. But again, because of the headlines that we're getting from the media, because of the tone of all of that, the consumers are getting different messages than actual reality. So selling above asking price currently, again, I've said this 14 times, but currently it's 52%. A year ago, it says 53%. Average percentage above of price sold above asking. So places that are going over asking price, currently it's 1.9%. A year ago, guess what that number, well, I won't even ask you to guess because it's ridiculous. It was only 2.2%. So it's not a big change. Accepted offer within the first 2 weeks and 32% are within a week. Currently it's 48%. A year ago it was 49%. Isn't that crazy? And then average list to contract time, currently it's 18 days. A year ago it was 18 days. So again, we have to be really careful with the headlines. We really have to take a dive into the numbers, and we have to be careful of the comparisons between this year and last year, because what we're seeing is my favorite is the foreclosure stats, right? Oh my God, we're up 185% from last year. Okay. Yeah. But we had a foreclosure moratorium a year ago, right? And the year before. So you have to go back to 2019. And if you do that comparison, guess what? We're still below 2019. So we're getting back to a healthier, more normal.
It's a more normal
housing. But don't take the year over year comparisons on some of these things. You've got to go back to pre-pandemic. And then also don't read the headlines and take that as the gospel truth. You have to take a dive into the information. And when you do, typically the story is very different than the headlines, but that's not what the consumer is taking away. So if you want to do something for your business, get online and make a 30 or 45-second video and post true information to help your borrowers navigate the current environment, which is tricky. And David is correct, totally.
It's changing.
It is changing. And yes, contingencies are coming back. And yes, sellers are not in the driver's seat as much,
Well,
right?
I'd love to have interest rates a year ago versus what we have today.
Amen, brother.
But I'd rather have the purchase market where it is today, where my clients are getting into contract versus, 6 months ago, last year, it was really hard to get people into contract. No matter how many approvals I had. Absolutely. It was very frustrating.
It'll get easier and easier. Many times, these headlines, as Audrey has correctly pointed out, sometimes they're going off of old news, say what happened in April or May or June. Hey guys, we're halfway through July already. Man, can you believe how fast time is going? And so, what is happening today? What happened, yesterday? What do we think is going to happen tomorrow?
Well, so 82% of June locks were purchases. 82%. What a difference a year.
Like I have one I was working on this morning where the client was thinking she was going to come in under asking, and now she's a few $1,000s over asking because they kind of realized, wait a minute, there's other offers on the table. You're going to have to bid a little bit more than the asking price just to get it because there's other offers on the table.
Well, but maybe not 20 now, but maybe 4.
No,
that's what I'm hearing, right?
Yeah, so 3 or 4 is pretty common right now.
Right. But we're also hearing, like recently had a little situation with a realtor who'd never heard of a PIW.
Yes.
How green are you when you don't know what a PIW is? So again, you want to do something for your business, educate your realtors. They need some help right now. They don't know how to negotiate. They're having issues with they don't even know how to have the conversation about, like, how do you pick up the phone and call someone and ask them for something or tell them that you want something, or you know what I mean? Like, if you were a listing agent, what'd you do? Stuck a sign in the front yard, maybe you slapped a little paint on the place and waited for the offers to flow in.
So I'll tell you a little trick I just did this morning on an offer where they had gone into contract and then they fell out of contract because of inspections.
Which they were able to have, I'd like to point out.
That was good. Yeah, they didn't waive the inspections. I used that old loan to input the new offer address on another property and see if I got another PIW. And I did. And so that way I was able to tell the client, yeah, we're getting a PIW on this property you're making an offer on. And therefore we can go in with a faster close because I know there's a PIW coming.
Oh,
wow. But that was lucky because I had an old deal that like jerry rigged it to make it work. But it was
okay. We're not going to talk to compliance about
I don't think you jerry rigged it. I think you just used information, you used knowledge, you used experience, did your homework, and you came up with a favorable. It could have gone the other way, Kevin.
Could have gone the other way, yeah. And I also was very caveat in my answer saying, listen, I got a PIW, no guarantee we will have one at close. Even when you get a PIW, it was always like you always have to disclose the appraisal fee even when you get a PIW because you never know what might change that would trigger an appraisal being needed. So for now, I only have a PIW, so it put us ahead. We're going in a few $1,000s over the asking price, and knock on wood, maybe this afternoon they're in contract. We'll see.
Okay, so Dave.
Yes, ma'am.
I am just wondering if you're here. I keep hearing rumblings that FHA is going to reduce their MIP to 50 basis points.
It will happen. It won't happen anytime soon.
Okay, so
it'll happen this year. Don't put money on it because I've been wrong, several times. But somewhere around October, November, you should see a decrease because again, the fund is just so massive. I mean, we needed to have by Congress, we needed to have that 2%. We're cruising above 8 right now. So with rates as high as they are, with people trying to get into homes, with FHA being a solution provider for homes, and then that barrier to entry on the mortgage insurance being so high, yeah, there's going to be more and more people that are pushing that. But then again, political climate is going to exercise some weight. And so if we were going to make an educated guess, it would be somewhere closer to the elections.
You think before or after? Let me just put your
slightly before the elections to help certain people.
when we heard from FHFA, when we heard from FHA when we were in Washington, D.C., they indicated this is something they were looking at. So I know it's on the table. It's just a question of when. So I'm always curious. All right, so when? So when?
Yeah, things move slowly. So if it happens, it'll be closer to October, November.
What were we talking? What were they talking about? It was FHFA with Sandra Thompson, and she was talking about something, and she's like, they've been working on it for, I'm not joking, 5 years. 5 years. And they're like, well, maybe in the next 18 months. And I'm like, oh my God, please, somebody needs to get in there with a, a poker and get people moving. All right. So there was, okay, let's talk for a minute about Sprout and First Guarantee, because people are very concerned about the market. And I've had a few conversations with non-QM people to get sort of the, a take on what they think is coming and what's going on. So first, let's talk about what happened with those two companies, because again, we are talking about a lot of people who are now without jobs, who are good people. And so I am a big believer in why can't we all win? And it doesn't have to be us versus them. And so with that, it's sad when these companies go under, and there's a lot of talk about more coming. So first of all, what happened with them, from my take, and Dave, you can see if you or Kevin have a different take on this, is they closed a bunch of loans that they couldn't sell on the secondary market because the rate climate changed so quickly. So if you are, and then the warehouse lines come in, they're like, all right, well, you got to make these good, and if you don't have a bunch of cash, you're kind of sunk, right? So would you agree that that is about what happened?
That's exactly what happened. I mean, cruising at $480 million of volume. And then you're sitting there thinking, okay, in the past, we got it off the line. In the past, we got it off the line. In the past, oh my goodness, nobody wants it.
Yeah.
And you get hit with, I think they were trying to sell 190 million, and they could only get like offers on half of it, round numbers. And so when you all of a sudden take $100 million out of your budget, that's going to hurt.
Right.
So, Home Depot, or Loan Depot, not Home Depot, Loan Depot, is planning on their 2025 plan. They're going to lay off 2,000 folks. You have First Guarantee that laid off a bunch of people and took out Chapter, 11 reorganization bankruptcy. We have thousands and thousands and thousands of, like you said, Audrey, good people that were in the mortgage industry, and who knows where they'll be later. There was a lot of overhiring that was going on because things were so good for a few years. And now, hey, it's a different environment. So like we just said, what happened in, March, April, May, that's ancient history. That's old news. We need to know what's happening today, July 2022.
So speaking of what's happening currently, I was told that Ellington Hedge Fund, which is the backing for Lyncher, so they just did a round of 5% coupon, and apparently the last securitization that was done. And if your eyes are glazing over, people just hang in there, because you got to know something about this so you can talk to your clients about it. So I know it's a lot, and we're all trying to digest this as it is fed to us through a fire hose. So just bear with us, and make sure you stick questions in the chat if you have any. So anyway, so they did a 5% coupon. Well, the previous was 4%. So they're working through these old loans that they have to get through, because my question was, who's next? Do we know? Like, you know what I mean? And so if they're taking a loss when they're selling these loans, and the question is, how much of a loss can they take, and how, et cetera. So will there be more? Probably. But so here's the message. You need to know who you're doing business with, and you need to know how they're capitalized. Okay. So as an LO, you cannot go chasing the lowest rate. You have to ask questions about the back end, which we have not done before, right? Mm-hmm. We haven't done a lot of that as LOs. So I even had this conversation with an AE who was talking about changing companies. I'm like, you need to think about where's that money coming from for that company?
Yes.
Like, should you make a move?
Yeah, but if you look at First Guarantee, they were backed by PIMCO.
Right, right.
But, PIMCO, if you were to do that and do your homework, so sometimes even when you do your homework,
That's
you
true.
Get caught off guard. PIMCO, oh my goodness, how many billions, and how big is their piggy bank? The answer is huge.
But as a LO, you also got to be really careful, because you could do a deal here, and I'm just going back, in time, back to the days when I remember when, and you probably remember this too, Dave, but when companies were disappearing left and right.
The implodometer.
Yeah, but even before that, and where companies would disappear and you would have closed your loan, but you never got paid.
Oh, right. God, I remember that.
Yeah. So that's the other thing you got to watch out for is, hey, we got to watch out for our own bottom line is if who are we picking for this loan? Are they going to be around when it comes time to cut that check to pay us? Because if they go bankrupt, guess who doesn't get paid? Loan officers.
That's right.
Well, Sprout said that they were going to pay their people like the next day was payday. And I'm hearing now that nobody got paid.
Oh, wow.
That's
commission
awful.
checks didn't happen.
Well,
I don't know if that's true or not, but that
yeah,
I'm hearing from folks that there was zero severance, there was nothing, like if they had vacation days or whatever. So I hope those rumors are not true, but maybe
that would be hard. Bankruptcy court pays employees first. I think even before taxes, if my memory serves right from college days. But people that are in contract, they're the last one on the totem pole. Like the government gets their money first, so you're screwed.
That's that.
Okay, well, that's enough of that. I'm about to throw up. So let's talk about a little conversation I heard with Todd Duncan. So his message during these trying times is choose abundance over scarcity. So I'm going to say it again. Choose abundance over scarcity. Mm-hmm. I'd like to say that I coined that, but I did not. It was Todd Duncan. So he says that what we need to be leading with right now is abundance, then trust, and then advice. So, and connection. We need abundance, trust, advice, and connection. So you give advice, you have an abundance mentality, you make sure that you have you come from a position where your clients can trust what you're saying is true, and make sure you're connecting with them. When we talk about this a lot, make sure you're meeting with your clients, meet them, however you do it, whether you do it on Zoom, in person, whatever. I met with a realtor yesterday who I hadn't seen in a couple of years. And she was like, okay, so can we put another meeting on the books for, do you want to do 2 months or 3 months? And I'm like, people want to be connected. So reach out and do that. Take some effort, put a little more into it, and make sure that you are being a trusted advisor and not just, a rate machine, because that doesn't work right now. Right?
Right. Yep.
That's it. You don't have anything else to add? Nothing
else. Rate machines will get you in trouble.
Yeah, they are huge. Oh, and Dave, one of the things that I've talked about a lot is you need to talk about payments. You got to train your clients to let you do that. If they're talking about, I had someone the other day, they're like, what's the rate? What's the rate? What's the rate? And I'm like, we need to talk about payments. He goes, but what's the rate? And so anyway, he told me what this quote he had gotten, 6.25% and $39,000 in points. And I told him, I said, if you pay $39,000 in points, I will put you in timeout. That is crazy. Like, yeah, don't do that. Hello, you might have a chance to refinance. You know what I mean? In a few months. Do you really want to do that? So
Victor,
we have
San Vicente. Thank you for joining us. Okay. We understand you got to take off for a different meeting. Thanks for joining.
He's such a nice guy, Victor. Absolutely the nicest. Okay, so let's talk about some things that are coming up. So tomorrow we have a CPI number coming out, Consumer Price Index, and these inflation numbers are moving the markets, guys. So be ready for it. Make sure that you are not left hanging. And then we have the Fed meeting minutes on the 26th, or the Fed is meeting on the 26th, 27th. It's expected they will do another rate hike, presumably 75 basis points. So what are your thoughts on that? Do you guys think 75, 50, none, a million? What do you guys, Kevin, Dave?
I'm gonna let Dave go because I have my thoughts on this, but Dave, go ahead.
Yeah, I think it's all but assured. I'd be surprised if it wasn't 75 basis points. Again, inflation is a little bit runaway. It's way too high. And when they start to see the results, we have more inventory, mortgage rates are starting to come down. When we see some of the results, gas prices have come down, they will continue to come down. When we're starting to see some of the results, and I don't mean, they have an immediate impact, right? Okay? But, the Fed doesn't affect mortgage rates, guys, I know that. The Fed doesn't, affect gas prices, guys, I know that. But circuitously, it has an effect. So they want to keep getting this economy a little bit more under control. They're trying to have this soft landing. Whether they accomplish that or not, we'll see. But yeah, I'm very, very sure that 75 basis points, at least 50 basis points, an increase in the Fed funds rates will happen. But for our audience, ladies and gentlemen, remember, the Fed raising the Fed funds rate is good for us a little bit longer term. And when I say longer term, I'm talking, fourth quarter, though a friend of mine, and I won't mention this individual's name because you've also had him on the show. He and I were talking about when we thought things would change. I thought, closer to the latter end of fourth quarter. And what I mean by that is interest rates back down into the fours. He tended to think it would happen more like September. I'm thinking, wow, that's pretty aggressive. So that you guys understand, in the mortgage world, they already baked these hikes into the rate, but did they hit it correctly? In other words, did they increase it by 175 basis points? Did they go 2.5? Did they go 3.3? That's what you're going to see change. They go, yes, we nailed it. Secondary market, but yes, we nailed it. And so now we have this ability to drop rates, and you're going to see if we get into a recession. I am not agreeing with folks saying that we're in a recession right now, but if we get a recession, these are the tools that the Federal Reserve has to now lower interest rates. And when they start to lower them, you're going to see them lower, fairly quickly. So anyway, long answer for a simple question, but I want to get that in there. Kevin?
I got a longer answer, so it's
all right.
So I'm going to just share. This is so I'm just back. I was in England last week and Ireland the week before. Irish inflation rate came out while I was there, 10% last week. The euro hit $1 to the euro first time in many, many years. So they're parity right now. So the dollar is really strong. And why is the dollar strong? Because actually, it seems to me, from looking from the outside back in, the United States is getting it better than most other countries in the world, because the entire world is dealing with COVID. We seem to be doing it better than anybody else. And everyone seems to be focused on gas prices and stuff. Like, gas prices make up, so instead of filling your tank and it's $90, now it's $115, something like that. It doesn't make or break you every month. What I was sharing this with Audrey last week, I'm in the middle of I got a rental property and getting it ready for the new tenants. And last time I ordered new carpets, so I'd have, fresh carpets for the new tenants. And last time it cost $3,800 for new carpets. This time I got the estimate $13,000 for new carpets.
The last time that Kevin put new carpets in for his tenants was 1952.
No, it was 4 years ago. Okay.
Right.
So that's
4 years ago.
Yeah, no. So that, and then like the other thing we ran into is my brother during COVID had redone his fences and put in some nice cedar fences, because we should do the same thing on the rental property. And he didn't check with the contractor before he made the order for the thing. My brother spent $5,000. The bid came in at $20,000 for the same amount of cedar, suddenly 4 times more expensive.
Even the lumber prices have come way down.
I know, but that's what I had heard. That's why we were really surprised when we saw the numbers. So now,
do you see the breakdown between labor and the lumber by chance?
So that was just the price of lumber. Just the price of lumber. So here's the thing, though. The carpet, guess what happened? We didn't order new carpet. I have a hardwood floor guy coming out tomorrow, and he's going to give me a quote on just redoing the hardwood floors. And if not, I'm just going to clean them and be done with it. I'm not spending $13,000. So did the price of carpet really go up for me? No, I'm not spending $13,000 for carpets. It doesn't make sense for us financially to do that for new tenants. So, inflation is weird, and prices go up, people adjust, and that pushes the prices back down again.
That is correct. Because the carpet people are saying, hey, nobody's buying it at $13,000. Right. We better lower that to $10,000. Oops, nobody's buying it. Let's lower it to $8,000, which means, hey, we don't need as many people to make the carpeting anymore. So, hey, you're going to see more people go, in the into the unemployment area. So,
it's just like my perfect example of when I go to get a pedicure and a manicure, and all of a sudden it costs $110, and I'm like, forget it. I'm not getting a manicure. I can do that myself. Just do my toes, ladies. And so it is, again, they raise their prices to the point where I'm like, that doesn't make any sense and I'm not going to do it. And so they actually miss out. And until more of that happens, and if you saw the survey with small business owners, they are not optimistic. They don't feel good about what's coming. They're not planning on hiring. They're not planning on increasing their inventories. Like that sentiment right now is getting worse, not better. Yep. And it came in below expectations, which I thought was interesting. And so, you know, when people, it doesn't even matter if they're not doing it as well, if they feel like they're not doing as well, or if they feel like they're not going to do as well, that drives it just as much as the actual reality, right?
Yeah, that's crazy.
It is crazy. So again, you know, I'm not getting manicures, but whatever, I do it myself.
Show those nails again. Let's see how they look.
Pretty good.
Oh my God.
Not bad. I mean, you know, whatever. Okay. So also interesting to know, hourly earnings were up 5.1% year over year. So, you know, I think it's interesting. So yes, inflation is higher, but also earnings are up. Now that's hourly earnings. So that's not going to be everybody, but still it gives you a sense of.
Actually, I heard a funny story yesterday, and that was that employers are not having to beg and plead employees to come on board, that they can just make a decent offer and they'll come on board now.
But I just read that there's still 11 million jobs that need to be filled, which I think is interesting. And then the jobs report the other day, it was estimated we were going to get 350,000 jobs. Now remember, BLS is notoriously like revising up and down. So who the heck knows? They were expecting 350,000 jobs. They got 372,000 jobs. And Biden's said that what we really need is to be creating 150,000 jobs instead. That would help inflation. I'm like, okay, so how do you put all that together, right?
Yeah,
it's something.
We're about where we were before COVID. We're still shy at 500,000 jobs, but we are about where we were, you know, when this whole thing started. Yeah. So to Kevin's point, you know, it is the U.S. It is the greatest country on earth. We do have our act together. We are getting there. We're not there yet, but oh my goodness, all of these indicators are showing that we are at least on the right track, job-wise and things like that. Now, you have other companies that are competing with the Taco Bells of the world, where, you know, you drive down the street and the starting wage at Taco Bell, as you're looking at it going, what? I have to compete against that? You know, you have that teenager first job, you know, just
$21 an hour.
$21.50.
$21, yeah, $21.50.
And so you have people that are saying, oh my goodness, I have to compete against the fast food, just as an example. And so they're saying, wow. And so Kevin, to your point again, just make the offer good enough, they'll beat a path to your door.
Absolutely. I want to go back to this seeing the United States from outside. And I can't remember what it was, but it was just a comment I made to, you know, with cousins, and they're like, you know, so what are you seeing that's different in the United States versus here? And it's like, you guys put up with a lot of stuff that an American would never put up with. Not a chance in HE double hockey pucks that that's when an American would ever put up with this. Like you guys just tolerate it. And we're like, we can't tolerate that stuff. We are so impatient, gotta happen, gotta do stuff. I waited for probably an hour in line with 4 people in front of me at a rental car place. And I'm like, this would never happen in the United States. That's just not.
Have you been to the DMV recently? Okay, so last week I was in Mexico, and I tried to have a couple of conversations about this, and it was not as easy as I thought, but I did ask, like, what did people do during COVID? Because, you know, you're staying at this beautiful resort and beautiful views and everything's lovely and fine. And then you decide that you're going to go sailing in the Caribbean, and you have to take a van to get there, and you drive through these areas and you're like, holy smokes, this is how the other half lives, right? And it's not, and it really makes you think. There's such a stark contrast between, you know, what we're experiencing and what other people are experiencing. It made me ask the question, what did they do during COVID, right? Because it sounds like the Mexican government didn't do anything to help their private citizens. So if they were unable to work, I mean, I was in Cancun, so it's like tourism is probably the number 1, 2, and 3 industries. So what did those poor people do? And there was really no answer. I didn't get a straight answer. So somehow they made it through, but it couldn't have been pretty. And so again, I was having this conversation with a non-QM lender who knows that I, especially during COVID and the CARES Act, really sort of went from being really a free market girl to thinking, okay, FHFA really has a place in the market because they're kind of the stability when the private sector is, deciding that they don't want to buy a securitization of non-QM loans, right? So I don't know. I mean, I don't claim to have any of the answers, but I do have a lot of questions. And it definitely seems like a lot of what we did was right. I felt like the CARES Act really hit the nail on the head for the most part. It wasn't perfect. And when Kevin and I were in DC having lunch with a congresswoman, as soon as I said CARES Act, she would literally went right to, there's so much fraud. And that wasn't my takeaway. I thought it was interesting that a congresswoman's takeaway was, oh my God, the fraud. And my takeaway was we kept people in houses, right? And maybe they didn't all deserve to be kept in their house, but a fair amount of them did. And most of them made their payments, and most of them have come out on the other end with a lot of equity, and they are back to normal, and the lenders are whole, et cetera, et cetera. So I don't know. Thoughts, Dave?
Foreclosures may tick up a little bit now that we don't have all the free money,
Yep.
but what will keep it a little bit more in check is that one word, equity, that everybody has been accumulating over the last few years.
Yeah.
And so, if someone is between a rock and a hard spot, heaven forbid, they're between a rock and a hard spot, my heart goes out to, to those good people. Hopefully they will land on their feet because of the equity situation. They can pay off the mortgage. I know they don't want to move, but at least they may have some dollar amounts. I may have a neighbor that, yes, the home is over $1 million. However, he's been at his employer for 33 years. He's handicapped. And the employer is now saying, well, we think that you're going to cause maybe some, claim issues if you slip and if you fall. And so we're going to recreate your position. You're now off of commission. You're now in biz dev. And he put a for sale sign up on his house. He put a for sale sign on his house because he can't afford it anymore. And so your heart breaks for good people like that. Yes, he's got a ton of equity, and yes, he's going to be okay. And I hope most of these other folks are okay. But, you are going to see a slight uptick in foreclosures because of, just everything that's going around. So we hope that, there's a little bit more inventory, not because of foreclosures or not because of, people can't make, can't pay their taxes on reverse mortgages. But the silver tsunami that people were talking about, that's not really going to happen. Foreclosure mania, that's not really going to happen. They're getting more and more inventory, new inventories coming on, existing inventories coming on. So, looking at the National Association of Realtors for the last, 2 months, you just see this large uptick in inventory, both existing and new. I think we're going to be okay, but it's still going to be months before we see the sunny side of everything. And if we go into a recession, in my opinion, we will, it won't be as bad as what everybody thinks it's going to be. I was listening to a professor from the Wharton School of Business, and he's sitting there saying, yeah, it'll be a relatively mild recession. But again, you can't have highs without lows. It never moves in a straight line. There's always going to be peaks and valleys. And so I think overall, we're going to be okay. Yes, we're not out of it yet. I didn't say we're going to be out of it in this quarter because I don't think we will. It'll still be months before we land on our feet. But to both of your guys' points, greatest country on earth, never mind Mexico, never mind Ireland, never mind, the UK or any place else in the world. And I hope everybody else is doing well there. I think the US has got more of its act together. I didn't say it was perfect. I never said that. But, I think we're going to be okay.
Yeah. So I thought it was interesting. So they were, there's been a lot of talk about a housing bubble, to your point. And when we were in Sacramento in April, I had the DRE say, hey, remember when you told, because them and a bunch of state agencies, the Department of Real Estate, to be clear, they had told me that they were looking at how they were going to handle the upcoming foreclosure crisis. And I laid out all the things that we had been talking about on our show for the last 2.5 years. I guess it was probably 1.5 years at that point. And I said, okay, because of XYZ PDQ. And so they took that information and they did a dive into it, and they have redirected, along with other state agencies, their what they're focused on, because they agree now that that is the case. And they said, hey, thanks for that, because they were unaware. That's a Department of Real Estate in California. So there, we see a lot of headlines that say, housing bubble,
Housing
right?
bubble, yeah.
So listen to this.
You not only have California, but you have the Dallas Fed, just recently, a couple, 2-3 months ago, housing bubble.
Yeah.
And not like, again, to Audrey, to your point, these headlines, unfortunately, don't have all the depth in it as us in the trenches have. So anyway, cut you off. Yeah. I apologize.
Well, so they did a survey, not the DRE, a survey was done. 77% of consumers think that we're going to have a housing bubble. 77%, 44% of real estate agents think we're going to have a housing bubble. I mean, that is not great. So again, what do you do as an LO right now? You have a little extra time. You don't have 300,000 loans on your plate. So educate people. Become the
educate
authority.
Yourselves. You're right. Educate yourself.
If you're going to educate someone else, you must start with educating yourself. 100%.
So you have 4.8 million millennials that are coming into the marketplace over the next 3 years, as reported by the Urban Institute, by the National Association of Realtors. I mean, Dr. Lawrence Yoon says the prime age is 33. MBA says 33. You've got all of these millions of people, approximately 32 million millennials, that are going to be hitting the ripe old age of 33 to buy a house. Yeah. And we just don't have enough inventory. Right there, just that right there. We're not in a bubble. Folks, we're just not in a bubble. Then, unfortunately, when interest rates go above 5%, builders tend to kind of cut back a little bit. We need new housing inventory to the tune of about 1.7 million new housing units per year. We're going to be way, way, way short of that. So if you don't have new inventory coming in, and people with existing inventory don't want to sell their house because what the heck am I going to get at what rate, and then you have, these millennials that are coming in and they're super, super smart, the most educated. They're seeing their rents go up by, a tremendous amount, which is 40% of consumer price index. What do you have happening? A housing bubble? We are absolutely not going to have a housing bubble.
Okay, I thought this was interesting too. So they were comparing inventory levels between 2007 and 2010. So for those 4 years, and then 2018 to 2021. So listen to this. In 2007, there were 9.6 million units for sale. 9.6 in 2008, there were 9.4. 2009, there were 7.3 because everyone lost their houses. 2010, there were 8.5, right? In 2018, there were 3.7. In 2019, there were 3. In 2020, 1.9. And in 2021, 1.8. Okay. So again, this is existing home sales over 4 years. And you can see, like, you're comparing 9.6 million to 1.8 million. Hello, like that's not a lot, right? And then the amount of equity that's out there is off the charts too. So in 2009, 26% of houses were underwater, which, by the way, according to the headlines back then, and I didn't have my ear to the ground like I do now, I would have thought it was way more than that, right? So 26% of homes were underwater in 2009. Today, it's 1.5. 1.5. And by the way, I had somebody who was talking about a foreclosure they were working on. And I said, how is that even possible right now? They're like, oh, well, they owe some crazy amount of money. They haven't made a payment since 2018. And I said, okay, but still, like, how do you do that? Well, it was a $150,000 condo in, like, I don't know, one of the upper Midwest states. And so I didn't know they still had $150,000 condos, but if you haven't made your payment in 4 years, okay, I totally get it. Now you're in foreclosure because you don't have enough equity. So, because I keep asking who, where, how, right? Well, that's how. So it's interesting.
But they weren't making a house payment. What were they doing with all the money they made?
So it sounds like it was an older woman and like maybe there was cancer and there were some issues, right? Yeah. So I don't know that they were flaky. I think
medical bills wipe you out.
What?
Medical bills will just wipe it out.
Well, I mean, I find
expensive.
I find it fascinating that there's such a hyper focus on housing and mortgages and, you know, how we are with consumers. Yet my son had to go to the emergency room in an ambulance for a dislocated shoulder a month ago. And if we get out of it for under 20 grand, we'll be lucky. And insurance covered a teensy tiny little portion. And he's not even having surgery. You know what I mean? So why isn't that being hyper scrutinized by our people who apparently care so much about us? And food prices? Everyone has to eat. And how about energy? How about, you know, turning on your heat? How about all that? Like, there's no consideration for that whatsoever. But housing, oh my God, you forgot a $10 charge on your initial LE, and now you're going to have to do a, you know, anyway, it just, there you go. There you go. All right.
Fun times.
There was a question in chat, okay, by Kathy. Will we be able to watch or listen to the show again? I see it's being recorded.
Okay. So here's the answer to that. So
I already typed in an answer there.
You talked about previous shows, but Kevin, I think the question was on this one.
So this show is being recorded.
Okay, you answer, knock yourself out. Go. Let's see. I'll fill in the blanks.
We have recorded this. We have a new management company. I don't know the answer how quickly it'll be up on the website. Ideally right afterwards, but I can't say for sure.
Okay, so he has no idea. But that was a very good guess, Kevin King.
Yes.
Very, very good. Nicely done. So the answer is yes, I have been getting them. So I have been the one pushing the button on this thing, and I did figure out how to make it record. So we have the recordings. What I have not figured out how to do is how to send it out to everyone afterwards and how to post them. So it is actually on my to-do list, our to-do list. I'm sure Kevin's going to help with this week. And we are working on getting that done because we are getting a lot of requests from people, because we have people who come, you know, on Tuesday during the time they like to, you know, chat and participate, etc. But then we have a lot of people who listen later, and yeah, it's part of the transition. And actually, maybe that's a good segue into Kevin. There was a question going around about whether or not, you know, our position on with CAMP, California Association of Mortgage Professionals, and so whatever you hear, just know that we love CAMP. CAMP is our heart. We've both past chapter and state presidents. We love it very much. And so everything that we can do to support CAMP and the chapters, we are doing. We do not have the support of a couple of people, literally a couple of people at state too. Other than that, we are just here to give to our industry, and that's what we want to continue doing. So if you hear anything else, it is not the case. Kevin, anything else?
No, we're super active, and we're super active with the chapters. We were down in Orange County for their big event. It's very supportive. Even though leadership wasn't there, we were there helping them out.
Leadership. Their chapter leadership is amazing.
Yeah, their leadership is awesome. State leadership.
Yeah. So the reason we had to change formats was because we didn't have that support anymore. So it wasn't a choice that we made. It was foisted upon us, and we've just dealt with it. And we wanted to keep it as quiet as possible because we didn't want any drama. And that has been made difficult because there are certain people who love drama, and that's it. All right, moving right along, Kevin. Is that enough? That feels like
that's good enough.
God, we hate talking about this so much. So moving right along. So I just want to share with you who we have coming up in our lineup for you in the next month or so. So next week, Megan Anderson with MBS Highway. We love her. She's adorable. Although I saw her note that she's going to Europe next week, and I want to make sure, I think we scheduled around that. I'll make double sure. We have Dr. Elliot Eisenberg, who is a PhD that we actually love and respect, who is always full of—
Wait. Do you say you're not respecting other PhDs? And respect other PhDs?
I didn't say that.
Okay.
Did I say that?
Just clarifying.
I don't know. Anyway, and then August 2nd, we have Bill Lohman, who we love. He is past chairman for the California Mortgage Bankers Association, and he's also very involved with MBA nationally. So he is always a wealth of information. Plus, he's really fun. We have Rob Chrisman on August 9th, Josh Pitts on August 16th. We have Aaron D., who is the COO of Loan People, on August 23rd. We have Mark McArdle with the CFPB on August 30th. And that's all I got scheduled so far, but great lineup, right?
Yeah, make sure you're compliant before you watch a show with the CFPB.
Amen, sister.
Yeah.
I could not, there you go. Okay, so who is saying, Lena is saying, search Mortgage Pros 411 for the Zoom today and finally found it under register. Ugh, yeah, we're working on it, guys. We have a website, thanks to mortgage educators, thank God. And we have, I mean, a lot of why we have even this much of our act together is because of mortgage educators. So for that,
thank you, David.
Always be grateful.
No, thank you guys.
No,
thank you for providing this service to the mortgage industry where you have, oh my goodness, except for that guest that you have today, that Dave Luna guy, it sounds like the rest of your invited guests are pretty sharp. Dr. Elliot Eisenberg, yes, PhD, but I absolutely understand him. He's very energetic. He's very intelligent. He knows what's going on. Megan Anderson and just everybody else, Kevin Perenio for PRMG and just the people that you've had before. Bill, I mean, just everybody. I know I'm going to miss like half a dozen folks because you went out to the end of next month, but you have, you do provide a service, and I'm just very appreciative for everything you guys do for the industry. So thank you very much.
We love it. We just love this. We love the feedback we get, which is that, people appreciate it. So it's been our joy and our pleasure. And yeah, it's a lot of work, but it has made me better just because I pay attention to what's going on so I can share it. Right. And
I've actually gotten loans just because of this show, because the client will ask me something and I can just, oh no, the rule just changed. It just changed as of Thursday. And here's the new rule, blah, 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 blah. And I'm just saying exactly what we just talked about in the show on Tuesday.
Yeah.
It's really fun.
I met a woman who said, oh, I don't understand, I don't know most of what's going on. The Fed, it was right after the Fed's hiked 75 basis points. She goes, I just BS my way through it. And I said, okay, well, you could just like tune in for an hour a week. We kind of do it at we're not, I mean, I hear people talk about secondary market and my eyes glaze over because I'm like, I don't get all of it, right? But little by little, you start to learn it, you start to internalize it, it becomes part of your makeup and who you are. And it helps as an LO, just as Kevin was saying, he's absolutely right. I'm a better LO because of this. When I've got my client who is shopping for a $2 million house and I talk them into not discussing rates and only focusing on payments, that's because of this. That's because I knew something that I was able to tell them. And so again, we as LOs, and that's what your company's all about, Dave, is educate ourselves, right? And go beyond the 8 hours a year that's required. Make sure that you are an expert in your field. We make a lot of money. We are definitely, we are so blessed to do this job. And so we need to make the most of it. So we have a comment here, Dave. Dave Luna, can you just summarize where we are today and where the future looks before we sign off? Your knowledge is respected all through the mortgage community. So
that was really, really nice. Thank you. Where are we today? You're starting to see a trend of interest rates start to come down. And coming down is a relative term. Is it going to go back up? Guys, we're not out of it yet. So July, August, September, October, it's still going to be rocky. There's going to be good days. There's going to be bad days. We're not out of it yet. I'm forecasting that we really won't see any significant changes, meaning a downward, a significant drop in rates till at least December. But 2023 looks absolutely fantastic. And so as I talk to others in the industry, and when I say industry, whether it's Dr. Lawrence Yoon from the National Association of Realtors, whether it's, Doug Duncan, who's the chief economist for Fannie, whether it's Mark from, the chief economist from MBA, we're all looking at different kind of indicators and things like that. We're just looking down the road, and it looks like end of fourth quarter this year, definitely 2023, interest rates are going to be very, very, very cool, meaning they're going to be in the fours, possibly, depending on if we can get our act together. And here's the biggest problem is if you can tell me what's going to happen with the Russia-Ukraine situation, I can better tell you what's going to happen, because nobody can do that. that's why it's still going to be volatile. So will it go down into the threes? It should, but again, what's Russia, Ukraine, situation going to be like? Yes, lumber mills are getting, started back up because we have, COVID more or less under control. But even though you get lumber, you still have to bring it down to the marketplace. And so there's those transportation costs and things like that involved. So as soon as we can start figuring things out, my prediction again, gas prices will start to come down, which you should have started to see around a 5 to 10 cent drop in gas prices. That will continue to come down. Whether it'll come all the way down to $65 per barrel, I don't know. But again, when you were above $100, right, things were, really, really expensive. And so when we talk about transportation, fuel, when we talk about food, when we talk about other things, it's going to take a while, folks, for us to get our arms around this. And it's just, guys, it's not going to happen for months. And so I just want to emphasize, oh, Dave, no Pollyanna, rose-colored glasses. No, I didn't say that. It's not going to be for months. But then when we do get things under control, it should be under control for a while, and it should be really, really good. So inflation will be under control, not immediately, but eventually. Housing starts, those will come back as rates, drop a little bit more to help builders say, okay, there is a need for houses. Absolutely, we're not in a bubble. We do have to get a little bit more on new housing starts, as well as kind of figure out existing for a little bit. We're not going to see the tsunami in foreclosures that people were touting. And if you have a specific question, maybe I could ask that, because now I'm seeing more people on the chat. Is this really Dave? It really is Dave.
Because you haven't said frost my cookies yet.
I haven't said that. Just for you, Tony. Dang it. I don't like what's going on today. It absolutely frosts my cookies. So Tony, there you go.
Oh my gosh. I remember the first time I met you, Dave, and I wanted to knit in your 20-hour class, and I offered you cookies and promised I could knit without looking down, and it worked out. So cookies, we start at the beginning with
I can be bought with cookies, though. Please don't send any cookies. Love you guys. If you have any specific questions, I tried to do that whole thing in like 2 minutes. But if you have specific questions, I think we have a minute or two. Please ask. I'm turning it back over to our hosts, Audrey and Kevin.
Just remember, people, that housing remains strong during recessions. And the only time that wasn't the case is when in the meltdown, when housing was the cause of the recession. Yep. So that's the difference. Every other recession on the books, and I believe I heard they dated
back
1795 or something. It was some crazy
1795.
Seriously, first recession 1795. I'm not joking.
Wait, all the way back 1795. Only one recession had.
Yeah, because we caused it. And when I say we, I don't mean me, because I didn't do crappy loans. So anyway, it was 1795. Gosh darn it. Okay, I loved this headline this week, by the way. I thought it was hysterical. Because again, these headlines, good Lord, people. U.S. rates plunged to 5.3 in the biggest drop since 2008. That was the headline. Now, if you read that, what do you think if you're the average person who has nothing to do with the mortgage industry?
Woohoo! It's really dropped.
It's crazy.
And I feel old. I had a property that I had appraised, and the appraiser in the appraisal comments wrote, with interest rates at 10.5, this home should not sit on the market very long. I think it's relative. I think a lot of people have just been used to seeing rates only move in one direction, down, that they don't understand rates have been much, much higher.
Yeah.
I think what Chairman Powell is just working with is there was once a time when Fed funds rate did increase, but it did not get inflation under control.
Right.
Pretty much in my 42 years of doing this, every single time from Paul Volcker, Alan Greenspan, Ben Bernanke, Janet Yellen, guys, it doesn't matter who the Fed chair was at the time. Every single time when the Fed raises the Fed funds rate, mortgage rates come down. Again, I expect that you're going to see that again, but not until later this year, beginning of next year. So just sit tight. It'll correct itself. It has to. It can't continue the way it has been. It'll get better, I promise.
And work on your business, not just in your business. Work on making yourself better, get certifications, get your education done, create new systems. Take this time and be mindful of what you can accomplish when you don't have 2 million loans going. And so you're ready when we have more loans going. All right, with that, we are at the top of the hour. And we just want to say thank you again, Dave Luna. Absolutely.
Thank you, sir.
Appreciate you. Kevin Casey, nice to see your face in the United States again. And we are both
Patricia.
back.
Good to be back.
Travels, and we'll see you next week with Megan Anderson at 11 a.m. Pacific time. All right. Bye, guys. Have a great one.
See ya.
Bye.